Newbie traders place stop losses that are arbitrary, emotionally comfortable, or based on nonsense maxims like always keep your stop tight. Pros don't do any of that, and I'll explain how they choose their stops instead. I'm Lance Breitstein, 8-figure P&L per year trader with over $100 million in verified profits. And today, I'm going to teach you how to set stop losses like the pros. A stop loss is simple. It's a predefined exit designed to cap downside, reduce emotional decision making, and extend the longevity of your trading career. It protects your buying power. It protects your psychology, and over thousands of trades, it's one of the biggest contributors to consistent expected value. But most traders completely misunderstand stop losses. They think a stop is about avoiding pain, or they think it's about giving the market room, or they think if they just place it at some comfortable percentage away, the market will respect that magical line in the sand. That is not how markets work. Markets don't care about your emotions or your arbitrary stop placements. Let me break down how most traders screw this up so you can eliminate these mistakes starting today. First mistake, emotion-driven stop losses. Your stock approaches your stop, you panic, you widen it. It gets closer again, you widen it more. Eventually, you ditch the stop entirely and become a hodler against your will. All that does is destroy your expectancy and create monster losers that wipe out weeks of consistent gains. Second mistake, arbitrary placement. People put stops at fixed percentages or at whole numbers. I always stop out at -2%, or I'm gonna give this to $10. Why? Because it feels clean? Because it sounds disciplined? As if markets care about that? Third mistake, ignoring market context. Your stop makes zero sense if it doesn't incorporate volatility of the stock and the nuances of the specific pattern. Volatile markets with wider ranges often require wider stops. Looser patterns require looser stops. Tighter patterns allow for tight stops. We'll get more into this with examples later. Now let me pause this for a second. A lot of traders are convinced that the markets are going after their stops, or that markets are manipulated to take their stops out. I've never, ever heard a sophisticated trader speak like this, and almost always it comes from newbie traders that are placing their stops totally arbitrarily, or it comes from struggling traders that are looking for an excuse for their poor performance. If you are a good trader, and if markets were actually predictably going after the spots where everyone is placing their stops, then couldn't you game that system and do that as well? That's the point I never understood from those people. If markets are so reliably manipulated, why can't you just position yourself on the same side of the so-called manipulation? And if it's not reliable, congrats! Please see my prior point about your levels being arbitrary and you being fooled by randomness. So now that you know the biggest mistakes traders make, I want to walk you through how pros actually place stops. But before I do, I realized over half of you watching this video aren't subscribed. Subscribing helps the channel grow and tells me exactly what kind of content is resonating. So if you're getting value from this, click that button. All right, let's dive into how pros set stops. Step 1. Does the stop make strategic sense? Your stop should be placed at the point where you perceive expected value to be going negative. Expected value drives all of our trading decisions. Often, the place where expected value goes negative is where our thesis or reason for being in the play is invalidated. For example, an initial stop on a breakout of resistance can often be if the stock gets back below the resistance level. Or in trending stocks, if our thesis is that the stock is going to keep trending higher, we would get out where the trend is invalidated. In other words, if the stock has been trending and making higher lows and higher highs, you would place your stop below the relative lows, as that would signify the end of the trend. Same for if a stock is surfing a moving average. A sensible stop would be then if the stock closes below the moving average. This is also my go-to stop for trend lines. If a stock is holding an uptrend line and I'm riding the move higher, that break of the uptrend line would be my exit. By the way, if you want to see exactly how I use trend lines, watch my critique of Tori's trendline strategy. I break down precisely how I use trend lines in my trading. Step 2. Does the stop make sense for the time frame you're trading? As a general rule, my stops are almost always based on that same time frame that I'm trading. For example, if I enter a trade due to an intraday setup, it will have an intraday stop. If I enter a trade due to a daily setup, the trade will have a daily stop. This might not hold true for all traders and all strategies, but this is what has worked for me. Step 3. And this is by far the most important of these steps. The best way to be confident in our trading decisions is to have them supported by data. All of my trading systems are backed by data that shows them to have positive expected value. Pros do not guess. They do not rely on comfort. They study thousands of samples of their setups and identify the stop placement that maximizes expected value. Certain strategies and situations might call for a tighter stop, whereas other strategies might require a looser stop, but it is always tested. Let me give you an example. Let's say we're backtesting a swing daily chart breakout strategy like this IonQ. What we want to do is find as many similar charts as we can. Perhaps we find these Tesla and Bitcoin daily swing breakouts as comparisons. Studying our database of similar charts, we can propose a few hypotheses to test based on what patterns we visually observe. We can test ideas like giving it a trailing stop of prior bar lows or giving it until a close of the 20-day moving average. We could also test using a price target of a symmetric move equal to the magnitude of the consolidation range. Literally have a field day with it. Collecting that data is performing a backtest. At the same time, we can also then test those best performing hypotheses going forward in what is called forward testing. The key with both forward testing and backward testing is you want to make sure you don't cherry pick the outcome by trying to include all setups that meet the criteria you set forth. Step 4. Market context awareness. Volatile markets will, on average, lead to wider stops. That is because stocks have bigger ranges. As a result, if you want to keep risk equal, you need to size down. Most traders will use the same size in volatile markets, then to keep risk equal, they give a tighter stop than what their system dictates, which results in them ruining their trading system. Similarly, you'll find that if your stops are based on the technical pattern, the way that pattern unfolds often will dictate how good the trade is. For example, if our breakout system stop is to give to the lows of the daily bar, and that low of the bar was really tight up against the resistance level, we end up with a far tighter stop than if the bar had been much looser. That often is what gives a setup far better expected value versus otherwise. Step 5. Discipline and execution. The best stop in the world is worthless if you don't take it. Professionals treat stops as non-negotiable. Pros do not move stops impulsively. They don't arbitrarily override their own system. Stops exist to protect the long-term expectancy of your trading. If you struggle taking stops emotionally, build rules around it. Use hard stops, automate them, use daily loss limits, narrow the window for error. Size down to remove some of the emotions behind it, then gradually work your way back up. If you do this right, if your stops are backed by logic and data, you immediately move into the top few percent of traders who actually have a repeatable system. If you're serious about accelerating your trading journey and want to learn more granular details of where I enter and exit my trades, the same way I teach the 7- and 8-figure traders I mentor, consider joining my course. The link is in the description. Thanks for watching, and I'll see you in the next one.